Dominique, how you doing?
I'm good. How are you?
I'm fantastic. So guys, welcome to another session of interviews with entrepreneurs. And today we are chatting to Dominique Mullally. Did I say that right?
You did, yes.
I did, yes. Thank you very much. That's the first time. So Dominique is the founder and CEO of Financially Fierce Females. And she's been on quite a journey in terms of actually creating this, throughout her whole life to actually creating Financially Fierce Females. Now, Dominique, you are not only a qualified financial advisor, you do what? Is it NLP, EFT, was it hypnosis therapy as well? Am I right? In terms of something.
Yeah, I have a plethora of tools in my toolbox, shall we say. So no one has an excuse when it comes to working with me as to a reason as to not to build, why we can't build wealth. So I have the obviously the analytical and the logical skills because I have a background as a financial advisor, and I've been in the financial services industry for over 20 years. I've also built multiple six-figure businesses and created financial independence for myself at the age of 31. So from the practicality side, we're all good. But then I also have the qualifications in terms of the diploma in hypnotherapy, EFT, which is emotional freedom techniques, and yes, NLP, which is neuro-linguistic programming. And the reason for that is because on my journey to getting to where I am now, what became very apparent to me is, I'm great at strategy. I can give you strategies all day, every day. But what became very apparent very quickly was the difference and the disconnect between money when it comes to women and men. Men are very logical. They're just like, yeah, tell me what I need to do, let's get it done, right? But when it comes to women, there's a lot more emotions that go into it. So I guess where I'm quite unique is that I incorporate both elements of that. So I don't give personal financial advice anymore. But what I do now is help women in business really step into that CEO role and how to understand that their business is an asset that can be leveraged to build personal wealth. But how do we do that? So we get under the hood of really understanding how to build a profitable, sustainable business from the ground up. And then we put in place parameters that then allow us to create wealth. And we can either do that through the sale of the business, which might be a 5 or 10 or 15-year vision, or we can do it by accumulating wealth during the lifetime of the business. So that means you draw on things like dividends or your salary to start building ecosystem of assets.
Oh, fantastic. So I want to go a bit more into some tips and tricks and, that women can actually use, or even men could use in terms of actually growing that wealth. But first, I want to go back 20 odd years.
Yeah,
okay. So how did you, what drove you? I mean, you had a driving force behind you. I know that, you've been through quite a lot, as a kid, and then obviously, throughout your journey. Maybe take us through that story of what led to Financially Fierce Females.
Yeah. So I've always been a fierce individual in that, I was the child that wouldn't let anyone do anything for me. I was the nightmare child, as my mum called it. She's blessed now. She's blessed now because I'm very independent and I'm self-reliant. But back then, apparently I was a nightmare because I was so independent. I would always do everything for myself, but I was always questioning why. Like, why is something the way it is? So I was always very inquisitive. And then I grew up in Australia. So I'm 41, giving my age, I'm 41. And I have spent 23 years of that in Australia. So I've been back and forth on both sides of the world my entire life. And when I grew up in Australia. And then when I was about 12, my mum and dad said to me, we're going back to the UK for a holiday. And I was like, great, I get to see my family and my cousins because we had no family in Australia. And then when we got here, it was kind of like, oh, we're actually not going back.
Like, oh, wow. Just drop it on you.
I was like, hang on, let me catch up on that. So I have an entire life that I've just lived. And, coming from South Africa, Dennis, you know how different the life is in the UK versus somewhere where it's hot sun and pool parties in the summer.
We have some.
That's different. And so I was kind of like, oh, no, I'm not happy with this. And I remember I spent a good few years being really angry at my mum and dad. And obviously, I was at an age where I was reliant on them But I made a decision. I was like, oh, hell no. I'm going to get back to Australia by the time I'm 16. I'm going to do it on my own terms. And I think my mum and dad thought I was joking. They were like, okay, let's see you try. And I did. I like literally packed a bag. I moved back to Australia when I was 16. And, you know, that really solidified the journey of never relying on anyone financially to ever put me in a position where I had no freedom of choice. And that's really what money is about. And that's what I teach. And I really help women to embody. It's not about creating multiple 6-figure businesses or 7-figure businesses. Yeah. And when I talk about wealth as well, I'm talking about holistic wealth. It's not a numerical value. It's a feeling. I mean, obviously there's money that's involved in it. Course, it's more about, it's more about the power that comes from that. So that's really where it started for me. And then at 21, I went into the financial services industry, and I'd always been a little bit of a maths geek, which is like quite interesting because you know me, I don't come across like that, but I love. No,
you don't, not at all.
Yeah, I've got a thing for numbers and money and stuff, and so I became my dad's worst nightmare because my dad was, very against accountants and financial advisors, and because as he saw in his mindset, very negative, because those people were, accountants basically in corporations made people redundant.
Yes.
So they equated to job losses. And financial advisors, or stockbrokers as he thought they were, which I wasn't, I was a financial advisor, were just money grabbers, So I had to battle. Yeah, there was this like real thing. And then I had to battle through all of that. But I went into the financial services industry, and I immediately fell in love with all of the things that are building wealth. And I was like, why is no one teaching this? Like, it's, and, I don't want to get on my soapbox about this, but I will, if you can just bear with me.
Of course, go for it. Please go for it.
The reason why, and this is why I'm so passionate about it now, as well as what I'll explain in a moment, something that happened recently, but we are not taught this because we're locked into a system, right? So when you create wealth on your own terms, you remove yourself from that system. And what you're doing is you're financially literate. You're able to make decisions that come from a place of empowerment and choice. And you're not being driven by a 9-to-5 job, a credit card bill, or, how much the government wants to pay you, right?
Yes.
Because so many people, we're taught, we're indoctrinated from the day we're born, get a job, work hard, do well. And all that does is create and perpetuate a cycle of consumerism. And that's where most people are. So when you get into financial services, if you really, see it for what it is, which is what I saw was the opportunity, I'm like, okay, let me learn something here from these people who created immense wealth. And what they do is they don't work for their money. They put their money to work for them. They have strategies in place that, and again, it's not about being a millionaire, okay? Because a lot of people who have financial independence are not necessarily millionaires. I'm not a millionaire by any means. But what I do have is an ecosystem of assets that afford me choice. And that's what it's about. So I was like, why doesn't anyone know this? And then, so I moved back from the UK. I moved back from Australia, came back 10 years ago, got into a relationship, fell in love, got married. And then
I like the way you said that. Like,
yeah, we'll just skip over that bit. Skip over that whole 10-year period. But the important lesson in that was, and again, this is something that I see a lot of women go through, as they start to hit the mid-30s, going into the mid-40s, is a lot of women go through change. So they bring children into the world, or they go through divorce. And if they're in a relationship where their partner is maintaining half the running costs of a home or a lifestyle, if those running costs are removed because a relationship suddenly breaks up, then quite often 2 and 3 women will have to sell the marital home to fund like either divorce settlements or to be able to continue to maintain and sustain a lifestyle. And so I went through that as well, but I was in a position where I was able to buy this person out. I didn't lose my home. I didn't lose my income. I didn't lose my lifestyle because I'd built those assets, which meant that I was truly independent of anyone. System, a man, a woman, whatever it is, right? And that's really what I teach and what I embody, is to help people to understand that you can create wealth. It just means you just have to be disciplined, and you have to be very intentional with everything that you're doing in your business and with the money that you take out of your business. It is not a pie in the sky dream. It is something that you can make happen within a 5 to 7 year period. It's accessible for everyone, but it just requires a different mindset and a different strategy to make it happen.
Very, very much. I must say, even with myself, I had to go through that, quite a big mindset change. I mean, I went from having very successful businesses, selling them off, and literally squandering the cash. I won't lie. It's like parties and traveling the world and all of those kinds of things, to, okay, well, I need to go and maybe get a job now, kind of thing. I'm obviously talking 15 odd plus years ago. And then starting a new business. But I had to learn through that trial and error. So I can kind of relate that there was never anyone to actually teach me from that. Bearing in mind, I came from a very poor family. So, my father didn't know anything about financial advisors. What was that? I didn't even know what that was until I was in my 20s. You know what I'm saying? So, I could definitely relate to that. And I think the biggest thing for me was the mindset, and discipline was the other big one for me.
Yeah.
So, okay, listen, you don't need the Levi jeans. You don't need all of these other things. Take that little bit extra and just put it, invest it. And I think the biggest thing for me was the investing portion, not the saving portion. It was the investing portion, which was more important, because saving it, you actually technically lose money, don't you? At the end of the day. I think you pay more back.
Once you go beyond the security net of, obviously you need to have cash because you want liquid assets to make sure that you've got accessibility if you need it. But beyond a certain point, then it's like you're actually losing money. So
so let's take through, because a lot of the listeners and a lot of people are going to watch this replay are going to be entrepreneurs that have kind of like started off on the entrepreneurial journey, or they less than 2 years within the entrepreneurial journey. And most of them, many that I've spoken to, have come from pretty much almost similar kind of backgrounds, in terms of, kind of like hardships and ups and downs and all of that kind of stuff.
Yeah.
How do they start? Where does, someone start to build that wealth? Because a lot of people look at this and they say, but wait a second, I don't, I'm covering my bills at the end of the month, or barely, or whatever the case is. I can't build wealth. And the mindset is always, and what I've noticed as the trend is, okay, I'll wait until I've got lots of money and then I will build it. That's always the thing, but you can't do that, right?
No.
So take me through that.
So that's what I like to call the have, do, be model, right? So most people are like, well, I have this, I'll be that, then I'll do that. I'll have this, then I do that, then I'll be that, right? We need to reverse that. It's in order to get the have, we have to be. So what I always say is, I don't care where you're starting from. It doesn't matter. And also it doesn't matter as well. Like, the first thing is really understand that wealth, as I said, is not a numeric amount. It's not a specific, as in you can say to someone, oh, well, they've got £1 million or $1 million, so they're wealthy. Listen, I know a lot of people who have a lot more than that and actually are not wealthy, because a lot of the time they're living in cycles of debt. But also as well, their mindset is hoarding. They're going to lose it. Like they live in this cycle of fear. That's not wealth to me. Yes. Wealth, by definition, for me, is a holistic approach. So it's having an abundant mindset, looking for opportunities, and then also having the money that accommodates that. So it doesn't matter where you're starting. I want you to think about, what is your definition of wealth or financial success, and what would that look like to you? And the reason we want to start with that is because if we think about entrepreneurship, we think about revenues and profit margins and targets and things like that. A lot of the time, they're arbitrary numbers. They actually don't mean anything. People, especially when they first start out in the online space, they think, oh, well, I want a 6-figure business. I want a multi-6-figure business. I want a 7-figure business. Okay, great. Why do you want a 6-figure business? Well, because that person over there's got it. And I just want it.
Yeah, so true.
We need to what does that actually mean to you? Like, what does having 6 figures in revenue give you? because there's a difference as
And it's
well
you
between
personally that
revenue,
yeah.
different between revenue, profit, and take-home pay. Big, massive difference. So we always need to understand, what are we trying to achieve? Because our business drives our lifestyle. And the reason why a lot of entrepreneurs really struggle is they don't forward think. So they always are kind of like on the back foot when it comes to the revenue, because they're not setting targets that ensure that they can pay themselves every single month consistently, as well as the tax man, as well as the business obligations, as well as obviously the margins for profit.
Yeah, sure.
So the first thing is to start with the end in mind. Think about what wealth looks like for you. Think about who you would be when you're wealthy, right? What does that look like? And start embodying that now. And that also means being intentional in your business, making investments based on not where you are right now, but where you want to be 12 months from now. So instead of spending £1,000 on, I don't know, or $1,000 on a handbag, invest that money in something that is either going to bring you more time, more profits, or more personal wealth. It's about being a 6-figure entrepreneur now. It's about being a 7-figure entrepreneur. Or again, whatever your definition of that is, it's about embodying that now by way of your mindset. So thinking about projection, yes. 12 months from now, 18 months from now, 3 years from now, whatever it is. But then also it's the skills and the discipline of acting in accordance with that. So always be thinking, well, if you're like, say, if I was 6-figure Dominique, right, I'll just use myself. If I was 6-figure Dominique, what does 6-figure Dominique look like on a day-to-day basis? What's the things that she's doing in her business that create those results? Because if we think about the mindset and the compounding effect of results, that's how it works. You know, we often live in our past. Like our mindset is always programmed to be looking in the past, right?
Yes.
So when we're in our business, we're acting in response to experiences or things that have happened in the past. And that's where the abundance mindset comes into it. We need to be forward thinking about who we want to be and act in accordance with that and show up in a way that creates the results that don't happen overnight, because we need to talk about that. Business is not an overnight success.
Yes, 100%.
But it creates the compounding effect that then lead to the results that you want in the future.
100%. I think it's one of the most underestimated things is the mindset, you know, and programming your mind for. I mean, I look at even my past successes and even failures, for that matter. If I had to go really analyze my failures, why did I fail? Well, I can tell you now that my mindset was completely screwed up. I can guarantee you that was it. But it was when I changed my mindset and I started, and I mean, a lot of people are going to look at this and say, oh yeah, this is this whole law of attraction, or it's this, pie in the sky stuff, etc. The thing is, if you're not envisioning where you want to be, right, how will you ever get there? You got to think of it as a goal, and you got to be focusing on that goal and believing in that goal and living as if you're in that goal, and pushing it through. And one thing that I've noticed, you talked about wealth. So wealth for me personally is actually not money, I obviously generated funds, etc. But what it ended up becoming for me was time. Time is my biggest time with my daughter, to be specific. It was like, okay, that to me is when I can do, when I've got time with my daughter. So whenever I make money, I'm already working it backwards and saying, okay, so this amount of money, if I invested in there, will it get me how much extra time, to spend with. And so I'm always working it back from that perspective. Exactly. The same with, when I teach people the business planning, I kind of say to them, guys, how much do you need? I always say, what do you need on a monthly basis? Yeah. And then we work it out from there, what you need to do to achieve that within your business kind of. And so many don't. They kind of so fixated on this 6-7 figure business thing, but they don't realize that most 7-figure figures that I know have got huge debts. It's massive astronomical.
And also as well, like a lot of extra costs, because, Parkinson's law comes into effect. What happens is, when your mindset isn't in check and you're not forward thinking and you're really operating not in today's Dominique, but in 5 years' time, Dominique, then what you're always doing is you're constantly expanding your expenses to meet that income. And you're never actually really getting ahead. So that's what I'm saying. You have to really always be thinking about where you are right now, but what more important, where do you want to be in the future? Because your future self needs to be acted upon today. Because, you know, and you touch on like law of attraction and visualization. It's not woo. It is not
exactly.
Woo. Every single entrepreneur, very successful entrepreneur, or even if you like to look at Jim Carrey talks about it, you know, the actor Jim Carrey talks about it. He walked around with a $10 million check in his wallet for years, and he visualized it and he visualized it and he visualized it. And what that does is it creates that state of being, because you become hyper focused on what your goal is. And again, it doesn't have to be about $10 million. It could be just building that business that, as you said, Dennis, because it's not really about the money. It's what most people are chasing when they're chasing money is time freedom. That's
exactly.
What
they want the freedom to travel, and to travel, you need the money, or whatever the case is. That's what it is. I must say, though, that I actually also walked with a check. I had $1 million check in my pocket for about 4.5 years, and that. And it was about.
Sorry, I thought you. Sorry, I'm going to stop you. Your South African accent. I thought you said chick. And I was like,
yeah.
I was like, what? I thought you said you I was like, oh, it means check.
Yeah, check. Well,
yeah, just for anyone who's English, it's check, not chick.
Yeah, check. I've been speaking to too many Americans.
Sorry, I had to get you on that one.
I walked around for 4.5 years with this check that I literally, in the beginning, I had a piece of paper, but it kept getting worn out. So what I did is I actually, on my bathroom mirror, and even till today, you know, I've got different things that I put up there, but every morning I'd write out, this is what it is, you know, this is what it looks like. And I drew it with a whiteboard marker. And in the evening, I've got the same. So I'm looking at it all the time. And I promise you, you know, when 2014 hits and I got that, you know, the first in US dollars, the million, it was like, man, this is just like next level, you know, kind of thing. So it works, I think, but you've got to practice that mindset. And each time you want to go buy a McDonald's burger, you got to kind of look at it and say, well, you know, what could you do for the price of these 2 McDonald's burgers, or whatever the case is? What else could you do? I mean, because there's that saying, right? It's like entrepreneurs, who was it? I think it was Steve Jobs that said, I can't remember, but entrepreneurs live like nobody wants to, so they can live like everyone only wishes to, you know, in the future. If you're willing to, you know, follow that process for 2-3 years, and it's not going to be 100% fun, you know, in terms of those luxury items or Levi's or whatever the hell you're buying, you know. But it's going to make the world of difference in 3-4 years' time. Yeah,
absolutely. And one thing I want to touch on there as well is, you know, with the mindset, the stuff that I teach is not a contraction mindset, as in, like, I don't believe in penny pinching. I don't believe in, you know, swapping out like $3 or £3 lattes and all of that. I want people to focus on the expansion of the income. So you can have whatever you want, but you just need to figure out the way to create that and the way to make that happen. That's not to say that you shouldn't be frugal. That's not to say that you shouldn't be financially responsible.
Correct.
But it's focused more on the expansion. Okay. It's not, I can't afford this right now. It's like, I'm choosing to not focus on this right now because I'm focusing on this, but how do I make that happen 6 months from now? So again, it's always forward thinking on the expansion of the revenue or the income that then affords you. And they can, you know, what I teach my clients as well is like, they're the sweet spots of success. Like, they're the things that you reward yourself with. So if it is, for example, you want a Chanel handbag, no problems. But make sure that you've hit your goals first, and that can be the reward for all of your hard work. But what most people do is they have a win and they think, oh, great, I've got all this money. And they go and spend the money, and then they end up in cash flow crisis because they forgot that they've got all these expenses that are going out. And now they're in a position where there's not enough revenue coming in. And that's when they're on the back foot, and then they have to desperately sell, and they have to. So we have to just be constantly mindful of, we don't want to be tight, because that creates more of a scarcity mindset, and that focuses on lack. But we do need to be financially responsible whilst we are expanding our 100%. Mindset to focus on the income side of things.
So when we look at the average entrepreneur, I mean, most of them have some kind of credit card debt or loan account, something along those lines. What's the first thing? Is that one of the first things that they should get rid of, you know, on their journey to financial freedom? Or is that something that they keep? Or what is the first thing that they need to get rid of and, you know, do away with to get to that end goal? Because a lot of people are, you know, so what does that mean? I need to pay off my credit cards. Does that mean I need to pay off my loan first? Or do I just take this money and invest it and keep those debts? Or what's the kind of process?
Yeah, so obviously everyone's situation is different.
Sure.
But to give a generalized answer, for the vast majority, I would say build it simultaneously. So you pay off your credit card debt, but you also build wealth simultaneously. Now, it might be that there's an 80-20 split, as in like 80% of it is going to paying off the credit card debt, and only 20% of it is going to building wealth. And that's looking at things like index funds and like low cost entry points for building wealth. But what that starts to do is it starts to create this different psychology around wealth building, because now what you're doing is moving from being a wealth consumer to being a wealth builder. You're focused on accumulating assets. And then you start to see over time the compounding effect of that money increasing. You're like, hang on a minute, I just hit 15% on that money. And over here, I paid 25% interest on that money. Let me think about that. So I'm not against, I don't demonize credit cards, because if you're smart with credit cards, you can use them to your own advantage.
Of course.
And that's where, but you have to pay it off in full every single month. That's a non-negotiable. You don't run balances, but what you do is you use the credit cards to pay for your expenses, and then you accumulate points, and those points can be used for
exactly. That's what I
class tickets.
That's exactly what I've got a credit card, and the only reason it's paid off fully every month, so I spend on it so I can get the points. And I literally use the points, which always upgrade me, you know, first class, business class, or whatever the case is. And, you know, it's a nice little bonus at the end of the day. You know, it's a, you know, 10 grand that's saved on an upgrade or whatever the case is. It's worthwhile, you know.
But these are all the little strategies that the wealthy do. The wealthy don't use their money, right, to accumulate wealth. Right? They use other strategies, and it's I mean, obviously when you get to a certain point, yes, but it's little strategies that you can implement like that. You need to get a handle, obviously, on your money management first, because I don't want anyone running a balance. But once you paid off your credit card, there's no reason why you couldn't incorporate a new credit card that is tied to air miles or whatever reward system is best for you. Great. And you pay it off every single month. But as I said, but always, the focus is also on building that wealth, accumulating that wealth. And there's different strategies that you can use to help incorporate that. But at the end of the day, the business is the thing that accelerates it. So you have to get your business in check first, because your business is funding your lifestyle. It's paying for your wages. It's paying for your salary. It's paying for your dividends. So you're not generating enough revenue to consistently pay yourself, then you're also always going to be in that cycle of debt where you can never get out of it. So it's forward thinking about using the business as the accelerator to accomplish all of your personal financial goals as well.
100%, and not there to cover your personal expenses, which I see a lot of entrepreneurs, you know, they obviously use the bank, the business's bank account to cover their personal expenses and stuff, which obviously leads to disaster at the end of the day. But you've got to separate, which is what I want to talk about now, is the separation of personal wealth and business wealth.
Yes.
You know, on that, what's your thoughts on that? And should it be combined? Should it be separate? What?
No, absolutely. It's a non-negotiable. It's a non-negotiable. Your business is your business, and the money within your business is not your money. It is the business's money. You take a salary and that's it. All the other money that's in there is to be used for the business, to grow the business, or as I said, to create more time or more profit or whatever it may be. It might accumulate to your wealth further down the track. You might take out a dividend if you've made enough profit in the business. And obviously we want to plan for that. But no, there should always be a clear separation, because again, where the lines get blurred and people will treat their businesses as their own piggy bank is when they get caught short with the tax man, you know, when they're inconsistently paying themselves and they're then running back those credit card debts, because they're always robbing Peter to pay Paul. and they never feel abundant because they're always on the back foot. They're always in scarcity mode or scarcity mindset. And so what that does is it drives a lot of this in the business as well, because you're constantly on that cycle of, I need to get sales, I need to get sales, I need to get sales, because you're just trying to meet financial obligations of the business. So you have to treat the business as the entity that it is. It's a separate entity from you. And you have to think, okay, well, we know what's coming in this month and we know what's going out. And whatever that gap is, like, leave it alone. It's not yours to touch. And then you start to project and forecast. And this is where, you know, we have to really be disciplined, because whatever financial target you want to meet over the next 12 months, that's where your forecasting and your projecting comes into it. And again, we don't take money out of the business unless we're in a position financially to be able to do that. And that's where an accountant or a tax strategist comes into it and says, well, actually, yeah, you're heavily in profit at the moment. Yeah. So the business can afford to give you, you know, 5,000 or 10,000 in dividends, not a problem. But we don't take out those profits until we're in a position to sustain cash flow, because cash is king at the end of the day.
Of course, yes.
Profit is just sanity. Cash is actually king.
Cash is king, exactly. People always wonder, they say, but Dennis, you should look at the profit and losses. I'm like, show me the cash flow. Exactly. I want to see the cash flow. The profit and losses, for my accountants to go sort the taxes and everything out, I want to see cash flow statements and balances. That's the important part.
Yeah, exactly. Because profit really, at the end of the day, is just an accounting figure.
Exactly.
Cash flow is the reality of the health and indication of a business.
Yes.
So when they're looking at lending and things like that, obviously they will look at your profit, but they're looking at your cash flow position. What is your assets? How much cash is actually flowing through the business each and every month to sustain the business? Because profit is, as I said, it's just a number at the end of the year. It might be pushed away into an account somewhere, but again, profit only comes once there is enough sufficient cash flow moving through the business. Correct. And that's more important than profit.
100%. Now, let me, so I've got a question here of, should you be signing personal surety on your business? So, I mean, that's
personal what, sorry?
Personal surety.
A surety is in like protection?
Yes, protection. So for instance, they need to rent a building for their business and the landlord wants personal surety. And that, should you or should you not? Because I mean, these are two separate entities, and you don't treat them as such.
No, exactly. No, they're two separate entities, because if for whatever reason something happens, you're then personally liable. Yes. And they can come after your house and any other assets you have from a personal perspective. So no, we never ever want to attach anything to us personally. We always put it through the business, through the company. It's a separate entity. God forbid, if the business ever went under, they can't come after you personally for that debt.
Correct.
So there might be an agreement in place for the director, yes, but they can't come after, they can't force you to sell your home to service that debt. And that's the difference between, putting it against the business versus putting it against your personal name.
I think that's the thing that I see quite a lot with a lot of entrepreneurs when they first contact me, is they've gone and signed some kind of personal assurance, you know, whether it's with landlords or suppliers or whatever the case is. Yeah, guys, you've got to be careful of that, because you could bankrupt everything you've built over the last 10, 20 or 30 years can disappear in a blink of an eye simply because of that. You need to negotiate. You need to put it down. And I mean, obviously, suppliers and landlords and everyone else are going to try. They're going to try to get you to do that, but you don't have to actually, you know.
No. And I can give you an example of this, actually. So someone I was working with a couple of years ago, probably about 2-3 years ago now, she was a startup business. She's now multi-seven figures. But she had hired a warehouse, and, you know, she was quite naive in terms of the agreements and the contracts. And apparently this is a known thing in the UK with commercial landlords regarding, what's the word I'm looking for? where there's like damage to a building, there's a name.
Oh, yes. I know what you mean.
Anyway, so she took pictures, she thought she was doing the right thing. And then when she handed back the keys, they told her that she was liable for £120,000 in damages.
Word.
What are you talking about? Now, that was all tied up in her business.
Yes.
There was no personal guarantees or assurances. Now, had that been the case where she was personally tied up in that, now she didn't have to go to court. They settled out of court, but she still had to pay the equivalent of £50,000, right?
That's
so even though she wasn't in the wrong, they took advantage of a vulnerable girl in a startup position. And we never want to think like that. We never want to be, skeptical, but we need to be smart, and we need to make sure that we're protecting ourselves. So always making sure that when it comes to these types of things regarding liabilities, they're always tied to the business, so that you as an individual can walk away unscathed, because in that instant, she had cash to be able to pay that out, right? If she didn't, the business would have gone bankrupt. And if that had been tied to her personally, she may well have lost her home as well.
Exactly.
So it is a very real thing that happens. And we need to be, as I said, we need to be always forward thinking, but always make sure that anything like that is attached to the business and not you personally.
Perfect. So I've got a touchy subject to kind of like, put out, right? Yeah. You ready for this one?
I'm ready.
Protecting your assets from your spouse, etc. So we're talking about businesses here.
Yeah.
Right? So, I mean, in the beginning, we're all bright-eyed, bushy-tailed and in love, right? So we're going to go start our businesses and, something happens, 10 years later or whatever the case is, and there's divorce. How do you protect your business? What's the kind of steps that entrepreneurs should take? And it's not to be horrible to the spouse. It's just to like, well, you want some. I've seen too many of my mates lose their entire business, like they had to sell their businesses simply because of a messy divorce or whatever the case is. They were so passionate. I mean, they loved their business. It wasn't just a money thing for them. It was like their baby, and men and women. So, how do you protect against that? What's the kind of strategies that people should look at when they've got their businesses to kind of, separate the personal from, business kind of assets?
Yeah. So the first thing is you need to make sure if you're going into a relationship, you have prenups in place, and that you have a solicitor who knows how to set up the structures and the entities, and also the agreement. That because obviously throughout the course of a marriage, they look at things like earnings, right?
Yes.
And they look at assets and things like that. So you need to make sure that there's a prenuptial agreement that's set up, where an agreement has been signed by both parties, that the earnings or the assets that may grow in relation to maybe a business or a company, whatever it is, will be solely attributed to that one party, the person who is actually the sole owner of that business. Yes. Because like you said, you've seen obviously people who had to sell it. I, on the other side, have also seen a lot of women who walk away with nothing because the men hide the assets.
I know.
Because they've got really good solicitors.
That's just crazy.
It's the truth. Honestly, like, some of my bestest friends live in, are very wealthy, and also live in one of the richest parts of the UK, which is Cheshire. Yeah. And at least 4 of them have been through really messy divorces where, we're talking like not millions, we're talking hundreds of millions of pounds of money have gone just like pushed away to the side, because they've had the men have had very smart solicitors who've been able to structure their businesses
in the right way. Yes.
And obviously accommodate certain things to make. So what I'm saying is always seek legal independent advice on your own without your partner as a first means to understand legally where you stand. If it's your business, where you legally stand, okay? If you were to enter into a joint ownership in a home, or you go down the route of getting married, because like in my instance, I didn't get married thinking that 5 months later, which is how quickly it happens, that relationship was going to implode. Now, I was in a position where I was fine. We had all of that. It was like literally clean cut. It was straight down the middle. There was no arguments around money. But money quite often enhances people's stresses when they're in a position where they have none. Exactly. So you really see the worst of people when they're in a position where they're on the back foot. So again, it's about forward thinking. No one goes into a marriage or a relationship thinking about the end. No one.
Of course not.
I mean,
of course not.
You know,
yes.
Everyone's
seeing the white picket fence,
Exactly.
Of course. So,
we all want that. We all want love and we want to be loved. But at the same time, on the flip side of that, when things do go tits up, right, which happens, it doesn't matter how much your best of intentions are, how in love you are with people. These things happen because it's called life. You want to make sure that you're in a position where you only have to deal with the emotional fallout of that and not the financial fallout. Because the financial fallout, you'll get over the emotions, right? But the financial fallout for some people can be catastrophic, and it can really be detrimental to their emotions and their health because they haven't got the money financially long term. Yes, there's always ways to make more money, and there's ways to obviously, you know, get that back. But you just don't want to be in a position where you're having to start over again because you've not been forward thinking and been selfish in protecting your assets. Because there's no, you know, there's no shame in being selfish. Like, I want to protect my assets. Like, I don't care how in love I am with someone. I want to make sure that all the things that I've worked my ass off for and sacrificed are well protected, so that if the worst happens, as I said, which in my instance it did, and I never seen that coming, trust me, that you're protected, because it's the worst position to be in, where you're then heartbroken and financially broke as well. That's like a double pressure. So always seek independent legal advice on your own to understand your rights and your position. And my truth is that if someone really loves you, they will sign that. They would accept that
100%. I mean, I would, if I was going to get married and someone came to me with that, I actually wouldn't hesitate. Yeah, sure, whatever.
Exactly.
You know, it's irrelevant. Why should I take a piece of what's yours? You know, at the end of the day, it just doesn't make sense to me. Yeah, but that's a personal preference. So let's talk about. So people, when we say to them they need to invest, right? They need to invest their money to make it grow, or etc. The first thing that I normally get is, okay, so must I buy Bitcoin, or must I go and buy, some of these, I want to become an instant millionaire, in 6 months' time, I'm going to be a Bitcoin millionaire or a freaking whatever millionaire it is at the end of the day. I mean, where should they really be focusing their funds? Where should they be investing? Should they be investing in, is it like unit trusts, etc., or should they be investing in stocks like Tesla and those kind of places, or should they be going, on the high risk side to saying, okay, well, we're going to throw our money into Bitcoins, etc.?
No,
I mean,
no.
Yeah. But a lot of people come because they have very limited cash and they've got that small amount. They're like, oh, no, we're going to take as much as we can and just throw it in to buy Bitcoins or whatever the case is. What's your suggestion? I mean, you're a financial advisor. You teach this stuff. So where would you say?
Yeah, so
I'd start off at as a starting point.
If it's too good to be true when it comes from an investment perspective, it normally is.
Yeah, 100%.
High rewards, it's high risk. That means that if it's, on average, the market on average, right, usually is somewhere between 10 and 15%, give or take, on average, across all of the funds and the companies, sectors, all of that, right? Now, is that to say that one of my funds last year performed 45%? Yes, because it did, but that's not year on year. But the problem I have is, if we talk about Bitcoin for 2 minutes, right?
Okay.
The problem I have with Bitcoin and the way it's being positioned is that it's not regulated. So what you've got is a lot of people who are all of a sudden Bitcoin professionals in a pyramid scheme, right? So Bitcoin is a very good asset if you know what you're doing and you get
if you know what you're doing. Emphasis on if you know what you're doing.
Correct. But all the people people that I know who've come to me about Bitcoin. And it's funny because I had someone the other week try and position, didn't know my background, but tried to position Bitcoin to me. And I was like, yeah, show me the information because I wanted to understand it. And it was basically a pyramid scheme. So the way that they make their money is like based on like people coming in and stuff like that. So what I would say to you with regard to Bitcoin is there's an opportunity absolutely to make money in any investment, but you need to understand how the market works, and you need to understand whether it be Bitcoin, whether it be index funds, whether it be Tesla, whether it be gold, whatever it is. These are long-term options. The wealthy get wealthy by accumulating assets over time. There's not a get rich quick scheme going on.
Of course not.
They, again, long-term focus. Okay, in 10 years time, I want to be retired. I want to have the option to retire. What does that look like? What do I need to start building in now? People who are really wealthy have assets, and those assets, some of those structures have been in place for 10, 15, 20 years time. So, can you make money pretty quick in shares or Bitcoin? Absolutely. Yes. Do I day trade? Yes, I do. But then I also know what I'm doing. I know what I'm looking for. I know how to read the markets.
I think that's the difference, because I do it too. And I mean, I do day trading as well, but you've got to know what you do, and you've got to go do the training. You've got to understand the stuff. This isn't something, stay away from, someone that says, "Oh, give me £1,000, and let me trade this stuff for you." You want to kind of stay away from that.
Yeah. Or if someone says to you, "Give me £1,000 and I'll give you 20 back."
Oh yes, then you must know.
No, that's a red flag, because it said sustainably, returns, you're looking at between 10 and 15%. That's normal risk. If someone starts promising you 1,000% returns, that should be a red flag for you. And that's where I have a problem with the Bitcoin, because that's how some people are positioning it. Well, give me 1,000, I'll give you 20 back. So whatever you're investing, you need to be prepared to lose that money if you are going to gamble. And what I mean by gamble is if you're going to trade and invest and pull it out, because that's what happens. That's where people lose the money, because you only lose the money when you cash out.
Yes.
So you might buy in at £1,000, and then all of a sudden the market drops, but you haven't lost the money. The market might have dropped, but you've still got the money. The money's still there.
It's just valued less.
Exactly. And like any cycles, these cycles move. So It might have dropped and it might be £500 today, but in 3 months' time, the market might have inflated, and now that £1,000 investment is worth £1,500.
Yes.
And that's where, again, the long-term strategy comes into it, because a lot of wealthy people accumulate their wealth based on the eighth wonder of the world, which is compounding interest.
Exactly.
So 100%. That's where you put your money into an investment, and you allow the dividends that are being paid, or the interest, or whatever it is, depending on the investment,
to go straight back in,
accumulate and compound. And then, so year one, for example, you might have, let's just use it flat, you might have £1,000, right? And the return on that was 10%. So now at the end of year one, you've got £1,100, right? So then you don't put any more money into it. And then by the end of year two, you've now got an additional 10% on that. So it's like
1,210.
Exactly. Yeah. So that starts to compound. And when you start to get into year 5, 6, and 7, that's when you really start to see the acceleration of the compounding effect come into play. And when I show people some of the graphs, they're like, it's like a mic drop. I literally just stand there and go, I'm just going to show you this graph. And I show them the graph, and I almost like have an imaginary mic, drop the mic, because their eyes go, wow, because then they put it together and go, oh my God. And I said, it works in the same way as an interest, like a credit card works. That's how we've been conditioned. So the wealthy use the same strategies, but for building wealth. It's about creating the compounding effect and allowing the snowball.
But it's always the long-term strategy. I mean, I look at even myself. I mean, for me, it's always, 5 years, at least 5 years ahead or 10 years ahead, and saying, okay, where's this going to go then? At that stage. Yeah, sure, I do go and cash in on some things when I want to go and do something like, when I really want to go and splash out. But 99% of the time, it's a long-term strategy at the end of the day.
Exactly.
So what's your thoughts around, we're talking about obviously listed kind of investments here, whether that's Bitcoin or gold or, whatever, Tesla, etc. But what about taking money and investing it into other businesses?
Oh, absolutely.
Because,
absolutely.
I mean,
as long as you do your due diligence.
So with another entrepreneur, just taking another entrepreneur and saying, listen, I know you need 50K, or whatever it is, or let's say 10,000 pounds. You need 10,000 pounds, I'll give you 10,000 pounds for 10% interest, 10% shareholding in your business. I think, and I mean, I've made the majority of my wealth that way. I've literally taken startup entrepreneurs and I've given them the cash and taken a percentage of the business, helped mentor them and, cashed in on that 3 or 5 years down the line, like hugely. I mean, it's like massive growth, especially if you're grabbing businesses in the startup phases. And that. So is that a good strategy or is it not? Or was I just pretty lucky?
100%. Absolutely. Because you're leveraging someone else's time and resources to accumulate your wealth. Correct. So you need to obviously make sure you're doing your due diligence.
Of course.
You need to really pay it. See, this is where you need to know your numbers. Yes. You have to look at the books. You have to really understand, is this business, is it financially viable for me to invest right now? Is the business, and it might not be generating a profit right now because it might be running at a loss.
But it's based on future profit, right?
Exactly. But based on future earnings or future profit, is there a potential? So doing your due diligence is one. Then the second thing is making sure contractually a legal agreement is in place. Solid. To understand, okay, what's the understanding with regards to the investment? And at what point do you then start to take the money out as an investor? Because quite often when you're investing in startup businesses and you're giving that kind of seed capital, which is what we call it, you might not be able to take funds out as a dividend at least for the first 5 years of that business.
Exactly, 100%. So it is always a long-term strategy. 100%.
Again, exactly. Exactly.
It's not a quick, I'm going to give this to you and in 6 months' time, I expect it back, 20 grand back. No, it's a long-term investment where they can then buy out those shares at the current share value at that time.
Exactly. And so everything that we're talking about today is about sustainably creating wealth.
Of course.
It's not about the quick wins. It's not about the overnight success. It's about
and there's other channels I can watch for that.
Exactly. Go to Reels or whatever. Yeah, but it's about creating foundations, which again, as I said, it might feel like you're just chipping away, and you're not really seeing the results initially. But then what happens is, as I said, in year 4 and year 5, it's like the hockey stick effect. It's like that. It does, yeah. And then all of a sudden it goes, and you start to see the momentum and the traction of all of those investments, whether it be in a business or whether it be in index funds or property or whatever it may be. You really start to see the momentum of that occurring. So again, as I said, it kind of brings us back to what we talked at the very beginning, is always starting with the end in mind, thinking about where you want to be and then formulating strategies that allow that to happen. And as I said, your business is your accelerator. Your business is the thing that can fund all of that, but you need to know your numbers and you need to be not afraid to get into bed with those, so to speak, get intimate with them.
Yes.
Because that's the only way that you can really pay attention and project and forecast to allow you the ability to create the time freedom, which is what most entrepreneurs aspire to be. So it's never really about the money. You get to a point, certain point of money, and it's like, what are you going to spend it on? Do you know what I mean? It's not about that. It's about, it's about the time freedom. It's about the emotional freedom. It's about being able to spend time with your loved ones. It's about having the peace of mind to be able to sleep easy.
Getting to the end of the month and actually not having to worry, is the rent paid or anything. It doesn't even occur to being able to walk into a shop and say, oh, I'd like to buy these snacks or whatever. And you're not looking at the price. At all, you're buying, and that's that kind of freedom that just, for me, that's the That's what I love about it. It's not, yeah, sure, there's cash, but it's that time and that freedom and that emotional, kind of relief. Because I remember I was at a stage where I was sleeping in a car. I'd lost everything and I was sleeping in a car. And, so I know that feeling of, taking, £5 or whatever the case is, and that's the last cash I got. And I'm like, well, do I buy food or do I buy water? Or which one do you? That's the worst. And I never want to go back to that kind of thing. So that to me was my win, and spending time with my daughter, that was mine. So we got a question here. What is your take on property? Is it better to take out a bond or rather save cash to buy your dream home?
Right. So buying a dream home, we're talking about wealth creation. Your home is not an asset, it's a liability. So your home is always going to be costing you money. So in terms of an investment strategy, it's not something that I would advise. If you're talking about wealth accumulation, you want to be looking at investment properties. So is the property either going to give you residual cash by way of rent?
Yeah.
And obviously, again, there's expenses that come with that. So you want to be looking at like a 10% yield on that. Or are you going to flip it, as in you're going to buy it and you're going to increase the capital value and then sell it for a profit?
Exactly.
But also as well, it does depend on your circumstances and your age of life. And the reason I say that is because government bonds, in terms of the interest that you're getting from them, it's not even worth it, to be honest.
Don't waste your time.
There's just no point. However, if you are at a later stage in your life, and this is where we talk about risk profiles and things like that, is you always want to make sure that your eggs are never in one basket. So I never advise everyone to go all in on property or all in on Bitcoin or all in index funds or whatever it may be. You want to be spreading that out. So yes, you can invest in bonds, but just know that bonds is not a way you're going to accumulate your wealth. It is a way for us to minimize risk. So it's because it's basically like cash. It's just bonds, as I said, there's no interest in it. There's no money to be made in it. It's just a big cash holding. Property, on the other hand, is a risky strategy. And I say risky in the sense that, potentially people can overbuy. So then they end up in negative equity. Or if you're looking to invest as an investment property, you run the risk of that property being laid dormant. Maybe the market,
or someone not paying rent, or COVID happening and people just can't afford to pay the rent or whatever.
Exactly.
So
go on.
So I mean, for your own property now, as I take myself, I actually rent my property. Mm-hmm. I don't own it. Okay. Yep. However, I do have investments in property that get rented out. Okay. But for my own property myself, do not own it. Okay. Yep. I do not have a loan against it or anything of the sort, It's literally, I'm paying a landlord and saying, here you go. It's a 2 or 3 year lease at a time, and I'm paying him. Is that a good strategy or not? Or
yeah, it is. And you know what? I'll let you know a little secret. You're kind of like the 1%. Because I have a property here in the UK, but my mortgage is actually cheaper than what I pay for rent. Figure that one out.
Wow.
But, honestly, it's ridiculous. I bought at the right time anyway, the price market, whatever. But when I first went to financial services, that's what I discovered. That was one of the keys to what a lot of wealthy people do is, again, because your home is not an asset. It's a liability. So in financial planning school, we were told that your house is an asset. And I learned pretty quickly.
Yes. Everyone's told that. Because everyone here will now say that, no, it's an asset.
It's not. Because an asset,
and if you're going to flip it.
Exactly. An asset by definition is something that pays you an income or appreciates in capital value. Now, obviously, yes, in some instances, your home will appreciate in capital value. But what do most people do? They upgrade their home. So therefore they grade their expenses. So they're never really in the back when it comes to being in front, right? So one of the strategies of the wealthy is exactly what you've just said, is you rent a property, and then you use all of that disposable income, because normally it's cheaper to rent than it is to have a mortgage because of all the reasons we just spoke about. Your house is a liability. And people will use that extra disposable income and invest in other assets that then make them more money, and then that money then pays for their rent.
Correct. That's
So
exactly.
if you look at,
that's exactly what
that's
happens.
the trick. That's the thing, is when you get to a certain point with wealth, your assets will be paying for your lifestyle, and it just becomes like the cycle of wealth. It's just a cycle. And
I must say, I did kind of do it unintentionally. For me, it was just I didn't want to be locked down into a certain place. I want, because I move and I travel a lot, etc.
Yeah.
So it was like, well, if I can rent this for, well, it's been 6 odd years and it's stood empty a lot of the time when traveling. But kind of my other assets have paid for this, at the end of the day, by the revenue that they've generated in terms of, rent fees or whatever, they were flipping them or whatever the case is.
Yeah, exactly. But you have to be smart and intentional. And you also need to understand, is that financially viable? So, for example, here in the UK, in some parts of the country, it's ridiculous, but it's cheaper to have a mortgage than it is to rent. Right. And that's the case for where I live. It's cheaper for me to have a mortgage than it is to rent.
Yeah. So in South Africa, that is also predominantly kind of the take on that as well. Because a lot of people tend to like, okay, well, the mortgage is slightly cheaper. And we're not talking big differences. Yeah, it's just slightly cheaper, But what I feel is that even though it's slightly cheaper, I mean, for me to purchase this place is going to work out slightly cheaper than my rent. But once I go and look at all the other things that need to be added onto this, now we're talking taxes, we're talking home improvements, maintenance, all of these other costs over a period. Is it cheaper? No. No, it's not. Not in the least, and that's what we're not seeing. As soon as we own the home, suddenly it's like, okay, well, you've got to pay all of these other taxes. You now got to pay all of the home improvements. And when something breaks, what do? I pick up the phone to the landlord. Listen, mate, the shower broke. A day later, someone's there. They fixed the shower. He spent 10 grand fixing the thing or whatever it is. It's like, hey, that's on my cost. I don't have to worry about it. It's not affecting my cash flow. I'm still paying the same amount at the end of the day. Exactly. So I kind of look at it more long-term than...
Exactly. And that's the way we have to look at it. And, people will say, well, hang on, but it's an asset. And again, it's not an asset until you sell it. And in most instances, people sell it and then just upgrade the home. But we think about it from an investment perspective. I can get better returns on the stock market. Like I said, so for example, if I'm going to invest £50,000 into a property, my cash, all in, I'm going to invest £50,000 and maybe hope that doubles in maybe 10 years time. I might walk away with maybe 80,000. I don't know.
Yes.
Or am I going to go all in on maybe a couple of investments in the stock market, ones that I trust and that I know? And I said, for example, one of the portfolios that I'm currently in now is averaging around 25% over the last 5 years. Last year, it did 45% in 1 year.
Oh, that's lovely, yeah.
So we have to, I think what it is property. People, it's not less risky than investing in the stock market. It's just because it's tangible, and because people can see it and they touch it, they trust it more.
That's it.
That's what it is.
And you've kind of been taught that you need to own your home. You need to keep it for the next 50 years or whatever the case is, and it will appreciate in value. Yes, okay. So something you bought 50 years ago might have cost you 10,000 is now worth 200,000. That's fantastic. But how many people are actually thinking of that longevity? How many people still in this day and age will stay in the same place for the next 20 or 50 years? Let's be honest. It's like, really?
Yeah, exactly.
You're not really changing your life or moving forward, because if you've got that vision of picturing that check, you're going to be sitting in the Bahamas, sipping on a margarita. You're not going to be living in your in your house, in the area you're living in now. I can tell you that now. It's not going to happen.
Exactly. And the other thing as well is like when I'm working with entrepreneurs and I say to them, okay, tell me what your 5-year vision is. And they go, I want to be debt free. I want to be mortgage free. And I'm like, okay, let me just challenge you on that a minute. Why do you want to be mortgage free? And they tell me all the reasons. And then I challenge them on the reasons why maybe they should consider otherwise. And they're like, okay, I never thought about that. Because again, your home it will always be a liability until you release some kind of equity in it. So there's other ways to accumulate wealth that then give you an income stream that don't involve the home. But again, it's a cycle of consumerism, because As I said, we're taught, work hard, get a job, get a mortgage. A mortgage is a debt, it's a liability. So it still locks you into the system. You're still having to pay back interest. And this is the other thing that people don't factor in, is they just see, well, I bought it for this much and now I sold it for this much, so therefore I've made that profit. No, you haven't. You've had to pay out for solicitors' fees. You've had interest.
Transfer fees, everything else. Yes. There's all of these.
Exactly. It's all of those things that people don't consider, because again, we're not taught this stuff. We're not empowered with this knowledge. So I'm really just here to challenge the status quo.
Well, I agree with you. And I think we must just be clear with everyone, guys. We're not saying that you don't go invest in real estate. What we're saying is,
no, of course
if you're buying houses, whether that's on mortgages or in cash or whatever the case is, and you're renting those out, or you're flipping them, in other words, building them up and then selling them at a profit. Yes, that's good. Doing it through your own house that you're going to live in, no, that doesn't make sense, at all, because you're not going to flip that. You're not not paying yourself rent. I mean, it's kind of like debits and credits, right? It's kind of going to balance at the end of the day. So, we're talking about if you had other properties and you're investing in those and you're buying those and they're generating revenue, or you're flipping them, cool, go for that. But your own property, it kind of doesn't. It ends up being a liability, unless if you're planning on living there for the next 50 years, which means that the goals that you've set yourself for the $1 million or $10 million you want to achieve is kind of like, okay, well, even if you have it, you're still going to live in the same place.
Yeah. Or unless, you formulate a strategy to use the capital value to then invest in other assets, so that's where you remortgage your home and then you invest in other assets, and that's another strategy that a lot of people use, is if they don't have the startup capital, so to speak, to get into investment properties, they'll remortgage the home. They'll use that capital to buy another investment property or to buy another investment that brings them the income or can provide them with the capital value. And then you do that again and again, and that becomes a repeatable strategy.
Of course, yes.
So we have to take risks in order to get rewards, but we need to be very strategical and think about, okay, what is that we're trying to accomplish? And what are some of the easiest ways that we can do this that are going to give me the greatest risk, but not necessarily create the greatest rewards, but not necessarily the greatest risk by having all the eggs in one basket, so to speak.
Okay, so I know we've gone over time, but I really enjoyed this conversation.
Yeah,
I think it's something that so many people need to, they need to better understand. And guys, if you want some advice or you want to go and follow Dominique, go log into our membership area. You'll see her profile there, all links to contact her, email her, follow on Facebook, Instagram, and all of those. And maybe reach out to her with regards to a Financially Fierce Females program. All right. Do you want to tell us a bit about that, the Financially Fierce Females program that you've got?
So I have the Financially Fierce Females brand. We have a membership. So it's a quarterly membership. And these are the conversations that we have. This is the stuff that we're talking about. This is all the bare basics, foundational stuff.
Great.
Getting you to step into that mindset of someone who wants to accumulate wealth, and then understanding the building blocks of what that then looks like.
100%. So guys, go log into our membership area. If you go to 30th of October, and that you'll see Dominique's profile there and all the links and everything to follow her, go to her website, etc. Guys, reach out. This here is powerful stuff. It's something I've had to learn myself through trial and error over many, many years. I didn't have the benefit of mentors really like Dominique at the end of the day. And you can accelerate and do it much faster than what I have by reaching out to someone like Dominique that knows what they're talking about and can kind of guide you, not only in terms of, the physical wealth creation, but also, the intangible stuff, which is even more valuable, time,
yes.
Stuff like that. So guys, reach out to her then. Is there anything you want to leave, like a lesson or maybe two, that you just want to leave with the audience to say, listen, guys, focus on these two things?
Yeah, I think just remember that anything is possible. Everything starts with a dream. We look at everything that's is around us, the desk that I'm using, the computer, the keypads, whatever it is. So it doesn't matter where you're starting from. Know that this is possible for you. But I said, you just got to be intentional and you've got to be hyper-focused in achieving that goal. But one of the biggest tips that I can give you is just start to pay attention to your mindset. and just notice the language that you're using day to day when it comes to money and when it comes to building wealth, or when it comes to interacting with people who have wealth or appear to have wealth. Because if you're saying that you want to create wealth, or you want to create financial freedom, or whatever your choice of language is,
yes,
and if we have subconscious beliefs that resist that for different reasons, like we think it's greedy or it's evil, or we're constantly telling ourselves that we can't afford something or it's not for us, then guess what? We perpetuate that. 100%. So just be very mindful. Just be very mindful of your language and your interactions and your habits when it comes to your relationship with money, because that is the core foundation of everything that will then lead you to being in a position of building wealth. And as I said, also just know that wealth by definition is not the specifics of, you know, $100,000 business or $1 million or pounds in the bank. It's not as specific as that. It really comes down to your definition. And once people understand that element, it becomes even more tangible.
Perfect. Guys, I'm just going to quickly share my screen here, and I just want to show you quick. If you log into our membership area, Interview with Entrepreneurs, and you scroll down to Dominique, you can get a profile here, and you can follow on any one of these links, your Facebook, website, Instagram, etc. So don't forget to log into your membership area if you want to follow Dominique. Dominique, this was amazing. I love chatting to you, and yes, I hope to chat to you soon again.
Yes, I'm sure we will. Thank you so much for having me, Dennis. It's been an absolute pleasure. And as Dennis has said, just feel free to reach out to me on Instagram if anyone's got any follow-up questions on the back of what we've talked about. But I just want everyone who's watching this, either live or on the replay, to just know that it is possible. And the reason that you started your business in the first place was to create freedom, and having more money and building wealth gives you the time freedom that everyone is aspiring to really have, because that's ultimately what it's about.
100%. So guys, we got Lavona saying 100% agree, interesting interview. Lana saying thanks so much for the valuable advice, Dominique. Thanks so much, Dennis, for arranging. It's extremely insightful. So guys, thanks so much. We look forward to chatting to you again soon, Dominique. I want to bring you on a board next time as well, and maybe we can add some more value. I love these discussions.
Definitely.
So thank you very much, guys. Thank you very much, and we'll chat to you soon. Cheers.
Thank you. Bye-bye. Bye.